Dinar shift. Welcome. The current financial discussions swirling in government offices, policy think tanks, and experienced investor circles suggest a fundamental shift is underway, one that could profoundly impact every individual holding the Iraqi dinar or planning for its future exchange. Today's report cuts through the noise and provides a necessary, grounded look at the potential reality forming behind the scenes, specifically concerning the prospect of heavy taxation on dinar gains. Many in the holder community are currently unaware of the policy groundwork being laid, but the early indicators strongly point toward preparations for significant revenue collection should a rate adjustment or major financial policy movement occur. This isn't a speculative warning, it is essential, factual information that demands your attention to ensure you can protect your financial position, irrespective of the size of your holdings or the length of time you have been collecting. Understanding these dynamics now, long before any potential event, is the single most powerful defense against unexpected and significant financial losses. The long-term interest in the Iraqi dinar has seen it held by individuals for various reasons, as a potential long-shot investment, a hedge against other economic uncertainties, or purely as a speculative asset with hopes for a favorable financial event. As we move through 2025, the global and domestic financial landscape surrounding the dinar is undergoing rapid transformation, often at a pace unnoticed by most casual observers. Authorities worldwide are diligently seeking ways to increase tax revenue, financial oversight bodies are enhancing their scrutiny of foreign currency dealings, and global economic currents are directing new attention toward various world currencies. Historically, whenever an asset, particularly one subject to long-term speculation, shows the potential for sudden and substantial wealth creation, governments swiftly begin to enact reporting requirements and tax frameworks. The current discussions around heavy taxation are a direct result of this anticipatory governmental strategy, positioning regulatory bodies to capture a percentage of gains from large groups of people should the dinar's value shift and mass redemptions begin. It is vital to understand the timing and context of why these tax discussions are emerging now. Governments globally are grappling with escalating budgetary pressures, complex inflation management strategies, massive military or infrastructure spending, and general economic restructuring following years of global volatility. When tax collection agencies identify an opportunity to capture revenue from a population group poised to experience significant, sudden financial gains, as is the case with long-held speculative foreign currency, they invariably begin their preparation cycle early. This preemptive move is not unique to the dinar. It has been observed during surges in the value of cryptocurrencies, major booms in precious metals, and significant foreign exchange events in other regional currencies. The difference here lies in the unique history and decades-long speculation associated with the Iraqi currency. Certain policymakers view this situation as a clear and legitimate target for potential taxation, believing that holders who receive unexpected profits should contribute a percentage of those gains back to the national treasury. Consequently, terms such as heavy taxes, foreign currency oversight, and capital gains modifications are increasingly entering the financial policy lexicon, serving as clear signals of a shifting regulatory environment that requires immediate attention and preparation. A common and potentially costly misconception within the holder community is the belief that taxation only becomes a relevant concern after a revaluation, RV, or a significant rate change has been finalized. This perspective fundamentally misrepresents the governmental approach to financial regulation. Tax authorities operate by preparing and implementing new rules well in advance of a foreseeable financial event, ensuring their systems are ready to act the moment money begins to flow through banking channels. This means that a dinar holder's preparation for potential heavy taxes must begin immediately, not at some point in the future. Should aggressive tax policies be enacted, they could be applied directly at the point of exchange, automatically reported through integrated banking systems, or triggered by specific foreign currency transaction reporting requirements. Furthermore, many individuals overlook or entirely misunderstand how gains from foreign currency are classified within their respective jurisdictions. Classifications vary widely, with some treating gains as capital gains, others as ordinary income, and some creating special categories for currency speculation. Due to these discrepancies, a large number of dinar holders could face an unexpectedly high tax liability, making the act of raising awareness now a critical step toward avoiding being entirely blindsided. Another critical point that warrants a serious focus is the speed and manner in which governments typically introduce new tax legislation. History shows that new financial rules are rarely announced with a generous lead time, allowing individuals to easily adjust their strategies. Instead, these changes often appear suddenly, frequently bundled within broader financial reform packages, and are applied almost immediately upon enactment. This reality gives an informed individual a profound strategic advantage. If a holder waits for a major public headline or a social media alert confirming that a new tax is in place, the window to legally adjust one's strategy and protect gains will have already closed. The truly smart approach is to operate under the assumption that tax policies will be significantly tightened the instant a major financial event involving the dinar begins to unfold, as this behavior is consistent with governmental action globally. Planning proactively allows one to legally safeguard more of their potential gains, structure any exchanges in a compliant and efficient manner, and avoid the inevitable costly mistakes made by those rushing under extreme pressure. Preparation, in this context, is not about predicting a specific date. It is about establishing a robust financial structure that is ready for any outcome whenever it may arrive. The potential for taxation on dinar gains to be more aggressive than anticipated stems from governmental concerns about injecting a sudden, massive influx of wealth into the system through a unique channel like foreign currency speculation. Policymakers often worry about the potential for market disruption, accelerated inflation, or the proliferation of unreported income. To mitigate these perceived risks, they may introduce stricter tax brackets, enhanced reporting rules, or even specific taxes aimed at discouraging what some lawmakers view as unregulated speculation. Whether a holder agrees with this philosophy is irrelevant. The practical reality is that such policies can directly impact the personal finances of regular individuals who simply bought dinar years ago based on the hope of a value increase. This mindset is why financial commentators are seeing internal discussions that involve potential tax percentages, ranging anywhere from 20% to 40%. While these figures are not guaranteed outcomes, they demonstrate the aggressive mentality being adopted by decision-makers who perceive a substantial new source of tax revenue. For the dinar holder, the most strategic and effective response to this possibility is not panic, but focused and intelligent preparation. We must now address the essential concept of tax timing, a subject often misconstrued by holders. The notion that cashing out early or waiting for an extended period can entirely exempt one from taxation is a simplification that ignores the complexity of modern tax systems. While timing is certainly a factor, its importance is strictly defined by the specific rules set by each country. For instance, some jurisdictions differentiate tax treatment based on short-term versus long-term asset holding periods, while others treat all foreign currency gains identically, regardless of the holding duration. If new specialized taxes are created specifically for foreign currency redemptions, the advantageous timing windows could be exceptionally narrow or even eliminated entirely. Furthermore, a non-negligee BLE possibility exists that some governments may implement retroactive rules, which could apply tax liability irrespective of when the dinar was originally purchased. This analysis is not presented to instill fear, but to offer a realistic view of how financial policy is occasionally structured. The intelligent response is to move beyond guessing and instead focus on establishing a plan that positions you effectively, ensuring that whenever activity begins, you are already well-informed and strategically ahead of the general rush. A critical, often overlooked factor for many dinar holders is the absolute necessity of meticulous documentation. Individuals who exchange foreign currency without proper and organized records frequently encounter significant difficulties when tax time arrives. Governmental tax agencies routinely require irrefutable proof of purchase, verification of the original cost basis, and detailed evidence confirming the date and location of the currency acquisition. Absent this comprehensive documentation, tax authorities are legally entitled to assume that the entire exchange amount is profit, a classification that could place the holder into the highest possible tax bracket. The seemingly small oversight of losing a single receipt could, in a large-scale exchange, result in losses of tens of thousands of dollars or more. Therefore, the immediate and vital task is to dedicate time now, before any financial event takes place, to create a secure, organized folder, whether digital or physical, containing every receipt, purchase log, date stamp, and note that helps to verify the complete timeline of ownership. This singular organizational action can dramatically reduce your ultimate tax exposure. The importance of seeking professional guidance cannot be overstated. A prevalent tendency among dinar holders is to attempt self-management of every aspect of the potential exchange, often based on the belief that hiring a qualified tax professional is an unnecessary expense or simply too complicated. However, when dealing with the potential for substantial gains from foreign currency holdings, under complex and evolving filing rules, having an experienced expert on your side is an invaluable investment that can save you far more than their consultation fees. A tax professional who possesses deep knowledge of international tax policy, foreign currency reporting requirements, and asset classification, can help structure the entire exchange process in a way that remains completely legal while minimizing unnecessary taxation. They are also essential in preventing common costly errors made by those attempting to manage everything alone, such as misreporting gains, missing crucial filing deadlines, or misunderstanding how current law treats foreign currency conversions. Even if a long-term retainer is not desired, scheduling a comprehensive consultation with a specialist well before a major financial event occurs is one of the most intelligent and protective financial moves a holder can make. Another vital strategic component that must be integrated into your planning is diversification. If the entirety of your potential wealth creation is anchored solely to the Iraqi dinar, you are simultaneously exposing yourself to both the possible heavy taxation event and high concentration risk. Strategic diversification should not be misinterpreted as a loss of faith in the dinar or a retreat from your original plan. Rather, it is the deliberate construction of a more resilient financial foundation. The goal is to ensure that a heavy tax event in one specific asset class does not have the capacity to destabilize or destroy your entire financial outcome. Many experienced planners prepare by outlining a strategy to convert a predetermined portion of potential gains into a range of other stable assets, such as tangible real estate, established stocks, physical precious metals, or other stable foreign currencies. Alternatively, utilizing secure savings instruments or long-term, balanced investment accounts can serve a similar purpose in creating financial equilibrium. The objective is to establish multiple, stable sources of financial security, thereby eliminating the reliance on a single asset to carry the weight of your entire financial future against the backdrop of potential aggressive taxation. Finally, we must address the mindset and emotional control required to effectively navigate the next phase of this financial journey. One of the most frequent and costly mistakes made by speculative currency holders is allowing strong emotions to dictate their critical decisions. Fear invariably leads to paralysis or panic selling, while excessive excitement often triggers impulsive, poorly thought-out actions. Neither emotional state is conducive to preserving financial gains. The most successful people in high-stakes financial situations are those who maintain composure, stay rigorously informed, and execute their plans based on established strategy, completely ignoring hype and rumor. You must fundamentally frame this situation as a long-term, complex financial undertaking, not as a sudden lottery jackpot. Heavy taxes, new reporting rules, and governmental changes are not insurmountable obstacles. They are predictable financial realities that can and must be prepared for. The individual who remains grounded, organized, and strategic will be the one who retains the majority of their potential gains, while those who allow panic to dictate their actions risk losing a significant portion simply due to a lack of preparation. A separate, yet critical area for dinar holders to address is the complex reality of multi-jurisdictional tax treatment. Many holders mistakenly assume that the tax laws of their primary country of residence are the only relevant factors. However, the exchange of global currencies can often involve intricate multi-jurisdiction interactions. For example, a holder may have purchased the dinar in one country, stored the physical currency in a different location, and plan to redeem or exchange it in a third region entirely. Each one of these geographical locations operates under its own distinct set of financial regulations, and in certain scenarios, multiple countries may legally attempt to apply tax laws to the very same transaction. Without a proactive strategy to address this complexity, a holder risks encountering unnecessary legal complications or even the significant disadvantage of double taxation. Some regions only classify foreign currency exchanges as taxable events if they exceed preset financial thresholds, whereas other countries tax every single cent of realized gain, regardless of the amount. Understanding these nuanced geographical differences is not a minor detail, it is an essential piece of knowledge that allows for informed preparation, ensuring you avoid discovering costly consequences after the fact. The exploration of legal structures represents another powerful tool available for protecting potential financial gains. Sophisticated investors globally frequently utilize entities like trusts, limited liability companies, LLCs, or other formal legal structures to manage their assets with greater safety, organization, and efficiency. It must be clearly understood that these structures are not mechanisms intended to conceal assets. Rather, they are designed to provide robust organizational protection and, in many cases, to unlock tax benefits that are simply unavailable to an individual operating in a personal capacity. Given the RIS eyeing prospect of heavy taxes being applied to dinar exchanges, Many forward-thinking holders are beginning to investigate whether legally placing their foreign currency holdings into such an entity could confer significant advantages or greater protection. For instance, an LLC can effectively separate personal income from business-related income, and a trust can facilitate the distribution of wealth to family members in a highly structured and more tax-efficient manner. Other legal structures can offer superior liability protection in the unfortunate event of a tax audit, while some provide greater flexibility when the time comes to transfer or manage assets following a successful exchange. These advanced strategies must never be attempted without the explicit guidance of a qualified legal and tax professional. But simply knowing that these protective tools exist is a crucial piece of knowledge for any serious holder. Another often overlooked area by Dinar holders is the accelerating capability of financial reporting technology. Modern tax authorities are now equipped with sophisticated software systems that automatically flag and analyze unusual deposit patterns, high-volume foreign currency activity, and transactions that appear to be significantly larger than an individual's normal financial profile. In years past, it might have been possible to conduct a currency exchange with minimal regulatory scrutiny, but in the current global financial climate of 2025, digital monitoring has become exponentially more advanced and pervasive. Furthermore, regulated financial institutions are mandated to report certain activities automatically, and in many jurisdictions, banks face severe penalties if they fail to flag what is deemed suspicious or unverified currency movement. This reality means that Dinar holders should not and cannot operate under the assumption that a large scale exchange will go unnoticed or unreported. All major transactions are digitized and flow through global reporting systems, meaning that tax authorities often receive near instantaneous updates when specific types of transactions occur. Instead of adopting an attitude of fear toward this reality, the strategic response is to fully prepare for it. Understanding precisely how these reporting systems function helps one to avoid procedural mistakes, ensure compliance with all rules, and maintain composure when the moment of the exchange finally arrives. Transparency, when backed by a solid and compliant strategy, is a powerful ally. The critical element of privacy protection is one area where many Dinar holders inadvertently make dangerous mistakes. Driven by the excitement of speculation or the desire to engage in community conversations, individuals often share far too much detail about their financial situation than is prudent. Actions such as posting screenshots of holdings, openly discussing the quantity of dinar owned, messaging strangers about specific exchange plans, or publicly celebrating expected gains can all serve to attract highly undesirable attention. In a world where sensitive financial data can spread quickly and be misused, this type of oversharing creates risks that extend well beyond simple taxation. Individuals who publicly display signs of potential sudden wealth become immediate targets for criminals seeking financial opportunity. Furthermore, scammers actively target individuals who reveal financial details online, and even tax authorities may direct closer scrutiny toward individuals who publicly announce expectations of a massive financial windfall. Protecting your privacy is one of the most powerful and freely available protective measures at your disposal. This means rigorously securing all your financial records, severely limiting who know about the nature and size of your holdings, and avoiding any discussion of your specific exchange plans with individuals who do not have a legitimate need-to-know reason. Privacy is not a practice of secrecy, it is a fundamental act of self-protection. A subject that merits special and immediate consideration is the strategic use of charitable giving, an area frequently overlooked by Dinar holders. Charitable contributions offer a dual benefit. They support causes that align with a holder's values, and in many countries, they provide substantial tax deductions. In the event of a major financial event, some investors proactively choose to donate a portion of their realized gains to community organizations, legitimate relief programs, or registered charities that they have thoroughly vetted. Depending on the tax laws in the holder's specific region, these structured donations have the legal potential to reduce one's overall taxable income, thereby lowering the final tax burden. However, the timing and structure of this giving are absolutely critical. Some deductions are only applicable if the donation is made within the same fiscal year as the exchange event. Others require specific forms of documentation, pre-approvals, or that the receiving organization be a registered charitable entity. If the potential for heavy taxes is realized after a dinar rate change, having a meticulously planned charitable strategy prepared in advance can offer both deep personal satisfaction and significant financial efficiency. This highlights, once again, why thinking ahead, planning rather than reacting, is the true path to navigating this complex financial landscape successfully. Maintaining a high level of up-to-date information is a non-negotiable requirement, as the world of currency policy is highly dynamic and subject to rapid change. Nothing poses a greater danger to a dinar holder's financial outcome than basing decisions on fleeting rumors, speculative online discussions, or outdated information that mixes facts with significant misinformation. In a volatile financial environment that is actively preparing for potential heavy taxation, relying on poor quality information can quickly lead to disastrous and costly mistakes. The major advantage lies in staying informed through reliable, official announcements, communications from verified financial institutions, and policy updates issued by recognized governmental bodies. There is no need to exhaustively monitor every single piece of global news every day, but a holder must remain acutely aware of any changes that directly relate to tax legislation, foreign currency transaction rules, and banking regulations in their key jurisdictions. Knowing what regulatory changes are approaching provides the necessary power to adjust a strategy proactively. Being informed helps you remain calm, dismiss baseless rumors, and concentrate purely on actionable facts. Financial success is ultimately not derived from knowing everything, but from knowing the right things at the right time. We must return to the vital aspect of emotional control, because it is often the first casualty when news of heavy taxes begins to circulate. The typical human reaction is one of fear or impulse. Some people panic and rush to prematurely liquidate assets, while others freeze and make costly errors through inaction. However, strong, effective financial decisions can only be made from a grounded and rational mindset. The most successful investors in high-stakes situations are not moved by their feelings, they move strictly according to a pre-established strategic plan. They understand that fear immediately restricts one's options, and clouded judgment is the single clearest path to unnecessary losses. If new, aggressive taxes are introduced, a holder's emotional stability will become their most important asset. It will be the foundation upon which clear, thoughtful decisions are made about when and how much to exchange, and which essential preparation steps to execute first. While maintaining emotional discipline may sound deceptively simple, it is one of the most difficult skills to maintain under pressure. Actively practicing it now ensures you are far ahead of the average person who allows panic to dictate their financial fate. A practical strategy that deserves deep consideration is the idea of phasing or spreading out exchanges over a period of time. A common flawed assumption among dinar holders is that the entire amount must be converted in a single transaction. This is rarely the most advantageous approach. Should heavy taxes come into force, a strategy of spreading out exchanges could offer tangible benefits by helping a holder remain in a lower tax bracket for a given reporting period, or by providing essential time to observe and adapt to any newly introduced regulations. Instead of committing to converting all holdings on the very first day, some individuals strategically choose to exchange their currency in smaller, manageable portions. This approach significantly reduces the overall stress, allows the holder to continuously monitor the financial environment for sudden shifts, and maintains necessary flexibility should tax policies unexpectedly change. While there is no need to commit to a singular, rigid plan today, understanding the powerful benefits of a phased exchange is crucial for both mental and financial preparation. Every significant financial event demands a structured approach, and phasing your strategy offers enhanced protection and greater control. The possibility of legally leveraging different geographical, regions, or banking systems for an exchange must also be considered, strictly adhering to the regulations of the holder's home country. Certain sovereign nations offer significantly lower tax rates or possess more favorable financial rules concerning foreign currency gains. Others may permit specific deductions or exemptions that could serve to legally reduce the overall tax burden. The purpose of this exploration is not to discuss illegal tax avoidance. It is to highlight the importance of understanding the legitimate, legal differences that exist within global financial systems. For a holder who travels extensively or already maintains international banking relationships, there may exist flexible options that are unavailable to others. It is imperative that before attempting any complex international transaction, a professional tax advisor is consulted. However, having the knowledge that geographical flexibility exists is an extremely valuable piece of information. It prepares a holder for the concept that their exchange does not necessarily have to be confined to one single place, at one precise time, or under one rigid set of rules. Flexibility remains a truly powerful asset when the global discu Sion centers on the potential for heavy taxation. We must now address the real-world financial impact of heavy taxes on a holder's final outcome. If tax percentages are ultimately set within the highly discussed 20% to 40% range, the net amount of money retained by the holder after the exchange could be dramatically lower than any initial expectations. For a small portion of the community who have planned meticulously, this will likely be a manageable consequence. However, for those who failed to prepare or calculate realistically, the resulting financial loss could be devastating and overwhelming. When a major financial event finally occurs, people often make the critical mistake of underestimating the powerful and compounding effect of taxation. They frequently visualize a large final number in their minds, without properly calculating the substantial amount that could be legally deducted. By confronting and understanding the possible tax outcomes today, a holder can adjust their expectations, plan realistically, and effectively inoculate themselves against potential disappointment later. Preparation fundamentally grants control. It transforms a deeply stressful, high-stakes situation into a manageable and clearly defined financial process. Most importantly, it is the only way to proactively protect the underlying value of a long-term holding. As we bring today's critical report to a close, the single clear message that must resonate is this: holding the Iraqi dinar in 2025 is a dual commitment. It is not solely about passively waiting for a rate change or a major financial announcement. It is equally about actively preparing for the substantial financial responsibilities that accompany the potential for significant gains. The prospect of heavy taxation is rapidly evolving from a theoretical concern into a tangible and realistic possibility. And ignoring this reality could cost a holder far more than they can currently realize. However, by diligently applying the key strategies we have discussed, proactive planning, maintaining accurate documentation, securing professional tax guidance, strategically diversifying assets, prioritizing absolute privacy, exploring legal structures, and maintaining unwavering emotional control, you position yourself to move with greater calmness, superior intelligence, and significantly more confidence than the average holder. This long journey is not merely about accumulating currency. It is a foundational process of building security, drastically reducing future stress, and proactively protecting your financial future. By staying disciplined and meticulously prepared, you will be truly ready for whatever regulatory changes may arrive, and you will possess the requisite knowledge and organizational structure to make smart, informed decisions that solidify your long-term